Kicking off the show today with a big number, $800 million. That is what Extra Space is raising in notes to go out and deploy some dry powder. I think the big question is, what are they seeing that many of us maybe aren't? We're going to lay that out for you today and why it's very, very important to you. Also, a Cerritos, California City Council meeting that is must-see TV. Welcome to the Self-Storage Report, the only new show committed to self-storage. I'm your host, Chris Berg. Also do land acquisition for Advocacy Holdings with my co-host today, the one and only Rad Thad, Thaddeus Campbell. Thad, great to see you, my friend.
Great to see you as well. Director of Business Development at S3 Partners, working to build self-storage and small bay flex around the country. Also, a person who spends at least 10 minutes trying to make my hair look as good as my co-host when we come on for the Self-Storage Report every week.
Dude, is that just a mic drop right there? Like, hey, we're done.
That's it. I'm done. I can sign off for the rest of the show. That's it. I will say this, guys. If you are in self-storage and you're investing in self-storage, you this whole thing with Extra Space goes to the point that this is a show you should be watching, right? What's happening with this $800 million, I think, goes to something we've been talking about now for 12 weeks.
That is not where I thought you were going to go after the hair comment.
I can't spend too long on your hair, Chris. I'm going to make you get a big ego. I'm not doing that.
So $800 million Extra Space goes out. They're raising some notes, 4.95%. I think what's important for us in the storage business to understand is that they've got $800 million. And I share this because I will never forget when I was at CSSA in Newport, the gentleman from Talinvest, they do some amazing financing for self-storage. He goes, look, we're not only just doing bridge loans now, we are doing bridge to bridge. And I remember Michael Shorts from SmartStop, he's the CEO there. They've raised $500 million Canadian money, Maple Moms. He's like, let's see, bridge to bridge. I got money less than 5%. Maybe I'll get into the lending business, right? Like, it was just, in my opinion, there's a couple things happening. They are loading up the guns, their gunpowder, I should say, to go out there and buy some of these assets they know are going to struggle, that came in the 2021, these high marks. They all underwrote it at X, and now it's 25% below that. So I think that's one thing. One other interesting thing I want to hear from you, and this is a big capital allocation conversation, is that I remember also on the recent Extra Space earnings call, you know, the Extra Space and Public Storage stocks have not been doing well below the 200-day moving average. And one of the guys on the call was like, hey, is there any like thoughts about stock buybacks? And Joe Margolis is kind of like, you know, we get a number that we'll definitely buy back at. And so they're going to go raise $800 million, 4.95%. If the stock continues to go in the wrong direction, that just seems like an obvious capital allocation strategy. What say you?
Two things I think are going to be strong outlets for them. Listen, they're doing bridge loans at almost double digits, right? So if they have $800 million at under 5% and they're able to go out to some of these distressed developers, we've talked a lot about 2023, 2024 being the highest deliveries we've ever seen. A lot of those deals underwritten in 2020, 2021, not performing to what their pro forma suggested, in need of that bridge money to get through. You have Extra Space here who's not upset to end up with the asset if for some reason the bridge loan doesn't work, and yet they're able to give that bridge loan at double digit or near double digit interest rates. Well, listen, if I borrow at 4.95 and I lend at 9.95, that's a 5 bip spread. That's a pretty nice return on that money. Flip to the next one, which is we're starting to hear a lot about cap rates across this asset class starting to rise. If you have capital at 4.95% and you can go buy assets at a 5.5 or a 6 cap or even a 6.5 cap, there's a nice spread on an asset you're going to own for the long term. So I think it's a masterful play by Extra Space. And if everything is going in the direction that the tea leaves seem to be suggesting it is, and not just tea leaves, the data suggests that it's going, then, you know, they're setting themselves up in a position to really take advantage of a shift in the market.
But I guess let's lay this out and make it very obvious. When you say the data, I'm curious what you're interpreting there. Well, here's what I mean specifically, just to add some more context. Like, if you're Extra Space, how many sites do they third-party manage now? 1,500, 3,000?
Yeah,
I mean,
they've all told, I think they have like 3,000, 2,800, something in that number. I should know that number off the top of my head. I don't.
But bottom line, it's a gargantuan amount,
It's a
right?
huge number.
The amount of data that they have in each area of the country to be able to say, wait a second, these are the rates that we're seeing. We know this guy loaned in 2021 at X. We know he's going to have to refi at Y. Like he's probably going to need some help, and they can step in with 800 million bucks and just go, yeah, we'll do that. We'll do that. We'll do that. And I
Yeah.
think what's really important for people to know, because you've been talking about this for a while, and kudos to you. I'm giving you a big virtual pat in the back, is you've been talking about, hey, there's going to be a lot more consolidation in this industry.
I think your point is so well placed. Somebody who I speak to a lot, Bo Agnello, is the chief operations officer for Go Store It. When Madison Capital and Snapbox combined, they had a combined about 140 assets between the two of them. A little more on the Madison Capital side than Snapbox, but they combined because they understood that going forward, in order to compete with Public and with Extra Space, and to a lesser extent NSA and Cube, and now Snapbox, SmartStop, there we go, they had to have an economy of scale when it came to their ability to collect data. So to your point about Extra Space, they know exactly what's going on in nearly every market in America because they have stores there that they have the income numbers for. They understand the reality of what the achieved rents are in these stores. So when you see them load up $800 million at sub 5%, it's because they have data to show them what's likely to play out. And as I said, I think those two outlets for them are, do they go and lend to people that are in some level of distress where it makes sense to lend knowing that they could end up with the asset? Or do they just simply go and buy the assets? Either way, it's a great situation for them to be in. And quite frankly, testament to how strong the REITs have been able to do given the headwinds that are going against storage, which is another thing we've been talking about for a few weeks. The fact that they're in a position to go raise this amount of money says a lot about the long-term prognosis of storage, although the short-term prognosis may not be as rosy.
Well, and I think right now they're doing what 1.5 billion in bridge loans already. And then just to be fair to Extra Space, within the press release, it does talk about, hey, we're going to pay down some paper and different things like that. So I don't want to have everyone interpret that, hey, it's $800 million of gunpowder just to go do acquisitions, but we all know money's fungible. So you make that argument. Again, I go back to, I think what's going to be really fun to watch, because I'm big into watching people allocate capital, is what's going to be their capital allocation strategy. Does there come a point in time in a future earnings call where it's like, oh yeah, by the way, we bought that X amount of, stock and did this and that with this money as well. Because again, at 4.95%, that becomes a no-brainer capital allocation strategy as well, unless they're just seeing that much better returns, like you mentioned, with cap rates rising and things like that. So I would encourage people to listen to those earning calls and watch. I think Joe Margolis is a super sharp man. Watch his capital allocation strategy. But the other thing I'm gonna wrap this up with for you, Thad, and just to talk to is, like, you look at 800 million here. You've got, as you've mentioned very well, it's $500 million of Maple bonds, which is 350 million US. But that's my point is over $1 billion potentially just sitting there waiting to go, doot, 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 just buying up assets.
From 2 of 5 REITs, right? And not even accounting for some of the massive, SmartStop, Storage Mart. I'm having trouble with names today. There's too many similar. Storage Mart, the largest private REIT, and then other private equity groups. There's a lot of money that's trying to get into self-storage. And it's one of the reasons we haven't seen cap rates go up as quickly as we thought they might. But I feel like we talked briefly about this. I was on a call yesterday with Maurice Pagoda, and he brought up the Yardi Matrix group call yesterday. Tyson Hebner, who does a great job of providing data. The outlook of the data, Maurice was like, this is not good. Right? It's like what the short-term prognosis is based on the data. We've talked a lot about, are we at the bottom as far as rates? Are they going to start climbing back up steadily? Based on I didn't get a chance to watch Tyson yesterday, so I can't really speak to it myself. But Maurice Pagoda, who's the owner of National Storage in Michigan, the largest owner of facilities, they have 70 stores across Michigan and Ohio. No, the data that's presented does not paint a rosy short-term picture. I'm going to get into a little bit more info as we go forward in the show as well. Again, maybe we're not fully on the other side of what's going on.
I'm glad you brought that up, and I do want to share this with you because this is a conversation we had last week where we've had a record now level of people not moving. So just want to repeat, not moving in the United States of America, which obviously does not bode well for storage. And so one of the things I didn't bring up last week that I wish I would have was more of a conversation, because I did get a chance to watch the Yardi Matrix yesterday. If you want to check it out, go to the CRE report, go to my LinkedIn page. You can see that there because I did live stream it. But I think an
Which you
important
sent me, by the way, and thank you. I just didn't get a chance to watch it yet, so I appreciate that.
No, all good. But I want to share this with everyone, and hopefully you can see this as I'm doing this on the fly, because I just think it's a very, I mean, let's just talk about the straight up demand, right? I mean, demand right now is what is seen within our industry because people simply aren't moving. Well, obviously, a big part of demand, and you talk to anybody, they're looking at immigration trends as you look at what was going on in Canada for a while and things of that nature. This is what's been happening over the past, let's say, 3 fiscal years in the US government, as far as these are just border encounters. I'm not talking all the people that we don't even get a chance to encounter within the border crossings. But my point is, in 2022 fiscal year, you had 2.7 million, 2023, 3.2 million, 2024, 2.9 million. You extrapolate this out, you're looking at maybe 700,000 people in 2025. That is a reduction of over 2 million people coming into this country. To me, that's a big demand driver.
Yeah, you'll see under there where it says one repost, and that one repost was yours truly. And my comment on that was that that's the city of Boston in 2 years, right? You're talking nearly 5 million people less coming into our country over the course of the next 2 years. And of course, the 2023 and 2024 inventory that came into self-storage is not fully leased up yet. And a lot of the 2024 is not even near fully leased up yet. And that new storage requires people coming to be able to moving and coming to communities to be able to lease up. And to your point, a piece of the puzzle that maybe helped keep storage occupancy high over the last couple of years, even with the poor housing market, and it's being curtailed. Does that have another negative headwind against the self-storage industry?
Yeah, I just think it's fascinating because, like you and I've said, hey, we're very excited about where this thing is going over the next, 5 to 10 years. But right now, it definitely is kind of churning through and making its way. So I want to move on to obviously what you've got in store for us as well. Before we do that, I want to say thank you to Tract IQ for being our data partner here on the Self Storage Report. They do an outstanding job of bringing you great data, great opportunities to look at, hey, what's happening from development standpoint, obviously demographics, all kinds of things. So thank you to Tract IQ. We're excited. We're going to be with them next week at the 50th SSA. So it should be a fun time. But go check them out, tractiq.com. Moving on, my friend, you want to talk a little bit about last week's, were you in Jackson Hole? I think you were, weren't you?
I have never been to Wyoming. I'm working on that. That's on the list. I lived in Nebraska for many years. I don't know why I didn't get to Wyoming at least once, but I didn't. It's on my list of states I haven't been to. That being said, the chairman of the Federal Reserve, Jerome Powell, was in Jackson Hole, and his speech last Friday was very closely watched because it was the first time he was speaking after their July meeting. 2 days after their July meeting ended, the jobs report for July came out, and not only was the jobs report poor, but they amended May and June as well. So, and took the numbers from north of 200,000 jobs per month to lower than 50,000 per month. So a massive redrawing of what those numbers look like, and shed a very poor light on job growth overall. Now, as Chairman Powell, one of his two mandates at the Fed, they want to keep inflation low and they want to keep employment low. Employment is low. But as he said in his Jackson Hole speech, I'm going to play a clip for you. There's some reason for nerves there.
This unusual situation suggests that downside risks to employment are rising. And if those risks materialize, they can do so quickly in the form of sharply higher layoffs and rising unemployment. At the same time, GDP growth has slowed notably in the first half of this year to a pace of 1.2%. Roughly half the 2.5% pace in 2024.
So forgetting about the GDP growth right now, because that's starting to come back up a little bit. I didn't mean to make you laugh, but talking just purely about the jobs, that's a distinct difference. And when he said unusual, the unusual is you usually don't have really low job growth with really low unemployment. I think we're right around 4% right now. So they're not worried about unemployment as far as the percentage is, but there is fear now that if there's some type of a bigger layoff situation going on. We talked earlier this year, and we've talked many times about what's going on with software engineering, some of the large companies with big layoffs. I think Microsoft's at 15,000 people already this year. year. They're now worried about that. Flip that with his conversation during that speech about them seeing tariffs starting to cause higher inflation. And we're in a spot where maybe there's a rate cut coming in September. I'm going to play clip number 2.
Risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. Our policy rate is now 100 basis points closer to neutral than it was a year ago, and the stability of the unemployment rate and other labor market measures allows us to proceed carefully as we consider changes to our policy stance. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance.
I don't know what you read into that, Chris. I'll let you tell me what you think you heard there, but I know what I think I heard.
Well, Thaddeus, I think I heard. I'm trying to do my best Jerome Powell impression. It's like, man, can it be more dry?
I tried to keep the clips as short as I could.
Here's the thing. Again, the GDP number he touted between the first half of the year just came out today for the second quarter. It was above. It hit 3.3%. It was supposed to come in at 3. If you're going to go and cut rates in September with GDP on an upward trend, inflation going up, I just think you better be in hard assets. That's all I'm going to say. I think the 10-year is going to go up because you're going to start to lose credibility with the Fed. And I wouldn't be a bit surprised because of the way Trump has played this, quote unquote, art of the deal. If Jerome's like, okay, you want me to cut the rates? You got to refi the debt? Watch this. I'll cut. Let's see what happens. And I don't think it's the right move for the Fed. I don't think, assuming that the GDP's numbers are accurate, assuming that the tariffs are going to start to impact inflation like many people are thinking, I just don't know if cutting rates is going to be the best move for the economy right now.
Well, forget about best move for the economy because this is the self-storage report, and let's strictly talk about how this impacts self-storage. Because a lot of people that I talked to, in fact, I talked to someone earlier this week where they said, hey, we're going to see rates get cut and it's going to open up the market. Well, be careful what you wish for, right? Because the last time we saw the Fed cut rates last September, and I'll share this graph with you, last September was the last rate cut, right? Look what happened to the 10-year Treasury. And this is wildly important because mortgage rates are based on the Treasury, not on the Fed rate, right? So look what happened to 10-year Treasury bonds in the wake of that rate cut last September. They went from 3.72 to 4.63, almost a 1-point increase, which is then going to translate to the cost of getting a mortgage on a house. We're already seeing historically low movement in the housing market. The last thing we need is to have it get even worse because mortgage rates go back above 7% again, Chris. So be careful what you wish for is what I'm saying here. I think that a quarter point rate cut, I'm trying to talk too fast, is on the table based on how I hear him talking. I don't think that's going to be a good thing for the self-storage industry at all if it does happen. I would be much happier if my last week's prognostication hold true and there is no rate cut. They just hold steady.
Yeah, it's going to be fascinating to see how the markets respond to that. And as you're saying, of course, just self-storage and the mortgage and real estate market overall. So again, we'll see what happens there. Who really knows? But it'll be, obviously, you can count on us to have our eye on it and keep watching it. So I want to move.
By the way, let me interject real quick before you move on. That's twice on today's show I've made you double over in laughter, so I'm happy.
There has been a few. I mean, yes, well done, Thad. So I want to get into this. I think this is a really interesting story, and I'll give some context, and then you and I can sort of play around with some of these clips. So being your AI storage guy, I've set up alerts within ChatGPT to, alert me about certain things that are happening in storage. So earlier this week, it sent me an alert about a big conversation in regards to storage in Cerritos, California. So clicked on it, and I think what's really powerful about what I want to share with you is I want to hear from these city leaders. If you've been out and doing development or acquisitions and you want to add on, I think we all know that, hey, storage is not a beloved asset when you start talking to planners, city council people, mayors. And I think it's important that we begin to educate city leaders around, hey, this is why this asset's really, really important. This is what you can be doing as a city leader to ensure that you're helping your constituents, meaning lower the cost of storage. And also, which you're going to hear from Cerritos, ensure that you give yourself the best opportunity to get reelected. One thing you're going to hear in this clip that I think is important to know with some context is that it was in October, I think 2024, within 2024, the single largest self-storage sale ever happened in Cerritos, California. One self-storage site transacted at $91 million. And so I want to play this for you, Thad. And if any time during these clips, Thad, you're like, hey, wait, I want to comment on that, like, please do so, because I think there's some really, really fascinating stuff going on in this conversation. And I will do my best to make sure that I hit these right. So the other thing I want to share with people is that some of these clips, they're a little bit longer than what we normally would want to play. So I want to give you that context. And the reason being, again, I really want this, Thad, for you, because you haven't seen these yet, but for this to really be an educational opportunity for us to say, hey, this is what's going on inside the minds of these city leaders. Hear what they're saying, and how can we better communicate about storage to ensure that we're giving ourselves the best opportunity to build great assets within cities. So this is the mayor of Cerritos, California, for this first clip.
Under our municipal code, the city of Cerritos restricts the city of Cerritos to have a maximum of 4 self-storage facilities. And that's how many we have in Cerritos, as it shows on page 3. So the city of Cerritos is allowing an oligopoly to exist in our city for self-storage businesses. And an oligopoly does not allow the free market to work. So my question, Kristen, is, in light of the city of Cerritos,
This is good.
enforcing an oligopoly of self-storage businesses on the residents of Cerritos, what other businesses in the city of Cerritos do we restrict the number of businesses?
Thank you, Mayor Yokoyama. I am not aware of businesses where we restrict quantity through minimum distance requirements between 2 like businesses. The city has ways of limiting the quantity of businesses, but
What businesses do we have does our municipal code specifically limit the quantity of that type of business?
I love that the mayor is like, hey, look, let's just cut to the chase. I asked you a question. I don't need you to run around. Like, let's get to it. I want to get your reaction to what this mayor is saying right here.
This just reminded me of the interaction with Matthew McConaughey and Joy Behar on The View when she was asking him if a person who believes in gun control can win an election in Texas. That's what that interaction just made me think of. I also love the fact that the mayor's template is blue. It's kind of ironic that he's asking these questions with a big blue banner behind his name sign. It's nice as a self-storage developer to see these kind of things being discussed at a city level, right? Because at the end of the day, when you create a restriction on the development of self-storage, who ultimately pays for that is the consumer of self-storage.
Yes, very well said. And so I think it's fascinating he's talking about this oligopoly. So here's another city council person.
I also thought it was awesome he used the word oligopoly correctly in a sentence. I had to look it up just for any of you, and I'm not going to tell you what it means. Go look it up, but he used it correctly. I'll say that.
Oh, see, I'm just presuming. So oligopoly obviously is where you've got a monopoly, which is one, and an oligopoly is few. And so what the Cerritos is talking about is, hey, why have we capped only 4 self-storage sites in the entire city? Like, what's going on here? We are actually allowing these self-storage guys to become extraordinarily wealthy and run an oligopoly because we've restricted it on ourselves, which is why I want to play this next clip. This is a city council person here from Cerritos that says, wait a second, what are we doing and why?
And then all of a sudden we put a moratorium, and then suddenly we stop getting inquiries. I mean, it seems pretty obvious to me that maybe those who are interested in developing, opening up.
And what I want the city leaders to understand, I hope people will see this and start sending this information to city leaders, is that it may sound cool because it's kind of been the trend across the country with cities to put a moratorium on storage. What I'm hoping you're going to take away from this conversation today is all you're doing as city leaders is hurting your constituents. That's it. Like, we all know basic supply and demand, it's basic economics. So I would encourage cities to sort of rethink about, hey, what's the best use here? Do we have a need for storage? And if so, then let's bring it in so we can actually lower those costs for our constituents. And you're going to hear another city councilwoman here in a moment talk about what storage can actually do, not just for your constituents, but also to beautify your city. We'll get to that in a moment.
Storage facilities won't go to cities that have a moratorium on it. So not only are we supporting an oligopoly, we're also it's kind of a self-inflicted wound where we're missing out on potential business opportunity bringing new businesses to our community, and also probably unintended punishing our own consumers. I would imagine that people or yeah, people who want to use Cerritos-based storage facilities probably live close to Cerritos, if not in Cerritos.
I think it's just such a powerful comment. What say you, my friend?
You just hit the nail on the head. They're punishing their own constituents by making this happen. And look, the flip side of this equation is let the free market economy play itself out. And there are going to be some times where developers overdevelop in a certain market and the developers get burned, but the constituents get a great deal on having storage for less than what market value should actually be. So the opposite side of this equation is that you let your constituents actually get access to a product that clearly people use at a much better rate.
So this is another city councilwoman. I want to play this for our audience so that, again, you can start to use some of these snippets to go out there and educate other city councils around why self-storage makes an impact. And what you want to notice from this woman as she talks about it, and like there's a lot I could play here. I only want to limit it to a few clips here, but she talks about, man, I go out to my garage, I got to park my car in the street because half my garage is filled with stuff. That's why I want more storage here so I can go actually store it. And she talks about the impact. Hey, if we have more storage, what could that do to actually clean up all the cars on our streets? Here's what she had to say.
That we're not really focused on the residential storage. Look at the parking overnight. How many cars are parking in the street? And most of us, I mean, I don't want, for me as a sample, we use half of the parking place in our house. I mean, the garage, and it's halfway. Some of them full taken by our own thing because we all been here living 40, 50 years already there. You know, it's a lot of junk and we didn't want to throw away. I even have my son's favorite shoes and hanging there by the door. So I'm hoping if it's reasonable the price. If we increase the height, they can make a loft in one storage room, another storage room, another storage room, so they make convenient for the residential use if the price is reasonable. And we encourage people to store their thing in the storage room. And of course, there was some payment there if it's reasonable for the resident. That'll be really great. So that way we can really see a clean street. And like one of my house areas, almost 10, 12 cars on one side. And in the future, maybe we should looking for what's the best interest for the resident. So,
I mean, what a novel idea, right? As a leader, you're going to look after your constituents, number one. But I love the fact she's saying, hey, the other beautiful thing that can happen here with storage is actually beautify our city because now we don't have a bunch of cars jam-packed on the streets and lighten things up and let the city be the city again.
It's the law of unintended consequences that always plays out when you start legislating. It's 100% why I'm a libertarian, and I think we need less legislation because what actually happens based on legislation is almost never what's intended from that legislation, right? So to her point, what an amazing intuition on her point to see, hey, you have people that can't afford to go store their stuff, so they put it in their garage, which means their car is now on the street, which is making our city not look as good.
I want to play one last clip, and I think this one's really, really important. There's a bunch I could play. If you want to go and see more of this, just, as you can see, City Council meeting, August 14th, City of Cerritos. But I really encourage you to watch it if you want to educate city leaders about the importance of this asset class. Here's one, though, that I think is really important because I think Gary Sugarman and people at the CSSA did an amazing job bouncing up against the legislation in California to say, okay, if you want to put, caps on our rental rates, then obviously you're going to start losing tax revenue. Well, that obviously drives a lot of the decisions for these city leaders is, hey, what's going to be my tax revenue? Sales tax, property taxes, things of that nature. So knowing that, it's probably important that you understand what are those revenue drivers for your city. This clip I want to play for you, not to say anything negative around the city council person. The point is that I want you to understand is that as you're speaking to these city council leaders, realize that they got a lot going on. They can't know everything about everything. So it's our job as developers, as people that are going to go in and be neighbors in that city by buying maybe an asset to help educate them about the impact that our asset can have on their bottom line. Again, I know there's a lot of sales tax and self-storage, and you've got property taxes that are funding a lot of K through 12 education. So help these people understand that. Why do I say that? This is why. This is a city councilwoman, don't know her name, but again, in Cerritos, and just listen to what she has to say.
The self-storage facility. If we convert or added more of the self-storage, my question is, then we're not getting the actual use of the warehouse and it's not generating any property tax or even sales revenue. Am I right?
So there you go. To hear an actual You're chuckling. What do you want to say?
All I'm thinking of is friends of mine that have a $400,000 a year property tax bill from their self-insurance facility. Yeah, no revenue being generated here. Don't mind us. We're fine.
Well, and again, like I'm sure that
Unbelievable.
woman's got a lot going on in her life, but I want to play that for people so you can say, wait a second, like I just assume everyone on that city council is going to know, hey, I've got a
No
big
idea.
tax bill, and they don't. And so it's really important for us to say, we want to be a good neighbor. We're going to definitely pay our taxes. It's going to be a lot, trust me. And that way it'll help them say, okay, I see this asset through a much different lens now, because you can pay some of our K through 12 funding, plus you can help clean up our streets. The other piece that they didn't talk about that I think is really, really important for us just to share real quickly, Thad, because I want to be able to help city leaders better appreciate what we do, is that I think self-storage is an amazing, amazing small business incubator. Like if you're a solopreneur and you're kicking off an Amazon business or whatnot, like this is a great opportunity to test and try some things with very low overhead so you can take some risks that otherwise you normally wouldn't take.
20 to 30% of facilities now, that are small business owners. That's really been what's keeping storage alive in the wake of the slowdown in the housing movement. Is that this small business owner is someone who's selling stuff on eBay or on Etsy or whatever site it might be, where they use a storage facility to keep their goods. And so not only are you getting a massive amount of tax revenue from one facility, but you're also then giving citizens in your city a way to make income that then allows them to buy a house, to pay property taxes. So yeah, it's, if you happen to have a city tax, to pay a city tax on their income. So there's so many levels where it's helpful to a local economy. Of course, the pushback has always been there's only one or two people working at the facility. It doesn't create a ton of jobs. That is an old way to look at storage, because while it doesn't have people working in the facility all the time necessarily, to your point, which is fantastic, it is an amazing small incubator space for people getting into small businesses.
And that business is going to have sales revenue. And so it's going to just add to the bottom line for those cities. So hopefully that is helpful for people that are out there in the self-storage space, and also for city leaders to get a chance to watch us. I want to encourage you, please take this video, send it to the city leaders that you're dealing with. I know we're going to cut this into some clips, or take those clips and send them to city leaders as well. And then, of course, next week, SSA coming up in Vegas. Want to invite you to come out and just come up, say hi to Thad and myself, and talk about maybe get some feedback for the show. And where are we going to be, Thad, next week?
Aria Resort Hotel and Casino, one of my two top spots in Vegas. So really excited. The SSA is moving up. We were always in the MGM Grand, which is a little bit of an older casino, but Aria is one of the newest places in town. Really excited the next time we do the show, Chris, you and I are going to be in the same building together at the same time. Looking forward to spending some time. Also excited, I'm going to give another shout out to our data partner. We're going to be live with Noah Starr as well next week when we go on the show. So shout out to the guys at Tract IQ. They've been so supportive of the show, and Noah obviously was our guest a few weeks back. He's going to be on again next week in Vegas, and it's going to be the biggest SSA show that's ever been. Obviously, we're talking about maybe some tough headwinds for the industry over the next, 2 quarters to a year. But that being said, there's still no other industry I'd rather be in. And the people that make up this industry are unparalleled. And so really excited to get out there, see a bunch of the other great people in the self-storage industry.
What I'm excited about for next Thursday's show, it's going to be obviously Thursday. And so Wednesday's a big day of a bunch of leaders in the industry talking about what's happened in the space. So we'll have some, fresh, brand new information to share with you about what the top people in this industry are saying about what they see happening for the rest of 25 and into 26. I think what's going to be fascinating, if this is the first time joining us here on the show, Thad and I talk a lot about the 18.6 year real estate cycle. There's definitely signs now of our thesis bearing and holding out to have some validity. Again, you never know. We'll see, but pay attention in the middle of 2026, end of 2026, things may be different than they appear today, which already is kind of tough for many, many industries and people. So this is the Self-Storage Report. Please share this with colleagues, friends. I want to say thank you for joining us here, and we'll see you back here next Thursday live from Las Vegas. Have a great day.